Hello and welcome to Dukascopy TV. Today I'm returning to the emerging markets and rumours that they may not experience the trouble that might normally occur after weak US data and a tapering Federal Reserve. There's been talk of a potential and healthy rebound this year, despite a definite plan by the Fed to continue reducing its stimulus programme. So what are the chances that the emerging markets will bounce back? Well, on the line I'm joined by William Lee, an analyst at the Economist Intelligence Unit in London. William, thanks for joining me today. Do you think we could see an emerging markets rebound in places such as Brazil and Argentina, for instance?
I'm not sure if we'll see a strong rebound, but I think possibly what we saw at the beginning of the year was certainly an overreaction by markets based on a combination of some fairly weak data coming out of the US in the early part of the year, particularly manufacturing, and some relatively poor jobs data, which were actually held down by the cold weather more than anything else. Likewise, with China, we're sort of seeing evidence of a clear slowdown, but it's still likely to. We're predicting it will still grow at more than 7%, which is pretty healthy. So I think that, coupled with some of the stories coming out of some of the more fragile emerging markets, such as Argentina, led to some fairly severe market jitters, which were perhaps a little bit premature.
Now, we know many investors are still pulling cash from EMs, but according to the CEO at the world's biggest cement production lines company, Thomas Schultz, he says investors have ignored the economic reality on the ground and that perhaps they've been too quick to judge the resilience of developing countries. Do you agree?
I would say it's a mistake to sort of look at emerging markets as one single asset class and see events in recent weeks as there'll be sort of mass contagion across emerging markets. I think it's important to distinguish between some which have slightly stronger and weaker fundamentals. A lot of the jitters in January were sparked by Argentina, which to anyone who's been looking at Argentina over the past few years would come as no surprise seeing that sort of news coming out of Argentina. But if you compare that to taking other Latin American examples, perhaps Mexico, which is less connected to fortune in China, the commodities cycle has less of an impact. So I think it's important for investors to be able to sort of distinguish between different emerging markets.
What specifically have you seen in your coverage of the Latin American market that still raises concerns about how much these, some would say, stronger emerging markets economies can be affected by huge developed countries like the United States?
I think this was most clear last year in the sort of midpoint of 2013, where the US Federal Reserve didn't actually go ahead and do anything, but just announced that it was looking at tapering its bond buying program. And this sparked off a sort of wave of sell-offs and currency depreciations across various Latin American economies, which then corrected itself later in the year, but has sort of re-emerged again in January. So I think that sort of showed us that talk over the past decade of a decoupling effect between emerging markets and developed markets was perhaps a bit premature as well. And US policy still has a very, very large effect on some of the larger emerging markets.
Looking ahead, where specifically in these stronger emerging markets would you be looking to invest, including the longer term?
I would sort of take a measured view. As you mentioned, some or generally emerging markets are much better prepared than they were. So I would be looking at countries with higher reserve levels, improved debt ratios, floating currencies, and this is something we've seen. Particularly in Asia. I was doing some analysis on that recently, and reserves in Asia are said now to be 10 times higher than they were during the 90s crisis, which puts them in a much stronger position to go into any volatility. We'll probably see similar bouts of volatility going forward across this year. I don't think there will be a sort of widespread rout. I think they are in a much stronger position than they were. I think a lot of the volatility has been caused by domestic factors. So, for example, Turkey, which is going through a political crisis, and then countries like Brazil and India, which all have elections, which add to a sort of sense of instability over the short term. But over the longer term, I would think that many of these places will get back to sort of imposing structural reforms that will lead to greater investment. This is something important in Brazil for sure. And so things will eventually calm down and people will move away from this idea that we're looking at this, going into a period of sort of huge rout on emerging market assets.
Okay, thanks for that. William Lee there from the Economist Intelligence Unit in London. Well, that's it from me for now. Join me tomorrow as we take a closer look at the dollar yen in our new programme, Forecasts. Bye-bye.